Welcome to the Real Estate Show with your real estate and mortgaging team, Terry Kilakos and Merav Marciano on CJAD 800.
Good afternoon, everyone. You're listening to the Real Estate Show. I'm your host, Terry Kilakos, chartered real estate and mortgage broker, as well as president of Northeast and CBC Alliance. And today we're going to be talking about rates, fixed, variable, and everything in between. And you might be saying, what's in between fixed and variable? Well, that's why you're actually tuning in today's show to find out exactly what we're talking about. Joining me, we have my beautiful co-host, Merav Marciano, chartered real estate and mortgage broker extraordinaire and vice president of Northeast and CBC Alliance. Welcome, Merav.
Thank you so much.
You're looking beautiful as always.
Oh, thank you. You just have to say that.
Yeah, I know. She is. Honestly, I think I have the most beautiful wife in the world.
Oh, my God. Thank you. That's so sweet.
And I've actually gotten a couple of people this week say to me, so I was talking to your wife and she scheduled us for, to talk and to have a meeting on this day. And I was like, you spoke to Merav about scheduling me? And they're like, no, Olympia. And I'm like, no, Olympia's not my wife. She's my office wife. So just to make it clear,
she's
Olympia,
the best. She's the best office wife.
Yeah, she's my office wife. Olympia is not my actual wife. Feel free to reach out to us online at nordest.ca. And you can also visit us on our Facebook page, which is facebook.com/Northeast Nordest and facebook.com/CBC Alliance Quebec. And if you haven't done so already, take a moment to subscribe to our YouTube channel, which is newsonthego.ca. There you go. So before we kick off today's show, a couple of little announcements, a couple of market updates, which I think are really important for us to cover. Bank of Canada had a meeting this week, and they decided, drum roll, raise rates, keep them the same or lower them.
Not do anything.
Status quo, baby. So everything is just been staying exactly the same. And truth be told, there is concerns about inflation. So some economists are talking about, we were talking about this just before, Merav. They were saying that...
so basically, I think most economists agree that by March 2022, we'll be seeing hikes. Some are even saying January, the next announcement. But they all agree that definitely by March, we'll be starting to see each time like a 25 basis points hike on the Bank of Canada benchmark overnight rate. And
we know this. I mean, we were expecting it. I think the last calculation that we had done, we had said that it's going to go up by 0.75 for 2022. So over the next year and a bit, we're going to probably look at a 0.75% increase. So what does that mean? The overnight rate is going to go from 0.25 to 1%. So, which is still very, very good. And then we'll see what's going to happen as we get into 2023. For those of you that have been listening to the show long enough, you'll remember a prediction that I actually had a couple of years ago where I said that 2021, we were poised to go into a recession in Canada, right? Because recessions are cyclical. Now, luckily, COVID happened, and it got us out. I know it sounds weird, luckily, but whatever. You know what I'm trying to say here. For the economy. So we avoided that recession, if you will. But that's not to say that it's not still going to happen. And what system did the Bank of Canada have whenever there's a recession that kicks in? Boom, they lower rates. So I wouldn't be surprised if we start to see an increase occur in the interest rates. So in other words, in the overnight rate, and then all of a sudden see it dropping off again at some point. So we'll see. I'm not saying that's
more over the course of 2 years?
2 to 3 years. Okay. Yeah, absolutely. Okay. So economists are saying that by March 2022, we're going to see an increase. Bank of Canada had said that they weren't going to raise rates until Q3 of 2022, but we'll see. And Q3 would be, August?
Yeah, more,
So,
the last 3 months of the year.
Exactly.
2022. But I mean, they're saying by Q3 of 2022, you're going to start seeing a significant difference in the rates. So we'll see. We'll see with respect to that.
Let's talk a little bit about fixed rates, right? Which was obviously something that was talked about as well. Fixed rates are on the rise since the Bank of Canada ended its quantitative easing in October. And we talked about it last year, right? So, and we've talked about it in previous shows. So the Bank of Canada, what happens is the government buys bonds, right? And by buying bonds, what they're doing is they're actually keeping rates low.
Yeah, seeing as fixed rates are directly related to the bond market, they're basically controlling the rates by being the ones buying it at a low rate rather than putting it out there. And they do the same in the States. It's still going on in the States. They haven't stopped quantitative easing yet. But seeing as it stopped here, we started seeing rates go up a little bit. And it's probably going to continue going up on the fixed side, no, Terry?
So here's the thing. So the Bank of Canada ends its bond buying program every year. So the government literally ends the program every year around October, so the end of October. And if you remember last year when I had COVID, I think this was in October of 2020, I was sitting in bed and I was bored, so I started doing a whole bunch of research, and I actually had realized that the Bank of Canada was going to be ending the program, and rates were ridiculously low at that point. So I put out a blog. If you remember, and the blog was basically Bank of Canada is going to be stopping their bond buying program, which they did at the tail end of last year. And then they started back up again in January or February, which they do every single year, and they're going to do it again next year. This is why we end up seeing a spike occur in interest rates towards the tail end of every year. And then all of a sudden we see the rates start to drop back down again in the first quarter of the following year. What had happened when I had posted that blog, I got a lot of pushback. There was a lot of Facebook. I make the joke. It's not a joke. I actually got booted off of Facebook pages because people didn't want to hear the truth, right? But it was a fact, and rates did go up, and then they went back down, and now they're gone back up, and they're going to go back down again, I predict.
So if we look at last year, a typical fixed rate versus this year, October to October, what would you say we're looking at?
It's a significant difference. So last year we were looking at rates that were under 2%. Right now we're looking at rates that are in the 2.5% range. So it's not, we're not talking about something that's earth-shattering here, but there is
a good percent higher.
Yeah, and the thing that you got to remember, guys, I mean, let's be honest here. Interest rates on mortgages that are this low. And I know that, a lot of people are going to say this is the new norm and this is what interest rates are, they're going to stay low. No. Anytime you're able to secure an interest rate that's under 4%, okay? Listen to those words. Under 4%, you are laughing all the way to the bank. Okay, so people will get bent out of shape when, they're like, oh my God, I should have gotten my mortgage, just a few months ago because my, interest rate would have been 189. And now they're looking at it and their interest rates are, 2.5%. But guys, let's keep things in perspective here. That is still ridiculously low, right?
Absolutely. Listen, back in 2006, 2007.
Yeah, 6.5%. 5-year fixed.
Yeah,
that's what it was. Yeah.
And posted rates at the banks were $6.99.
Exactly.
I remember it was.
Posted rates were actually
higher than that.
What they were offering was $6.99.
You're right.
I remember I had one customer. He had come in, and it's very vivid because in 2007 I was just starting off. So you always kind of remember your first couple of customers. Mind you, I remember everyone, but that's just my craziness. But there was this one specific customer where they had gone to the bank, and the bank was offering them $6.59 as an interest rate on a 5-year fixed. And they came to me, and I was offering $5.99. There was like huge spreads. There was like all kinds of, now there's no spreads. I mean, let's be honest here, guys. You go to the bank, they're going to offer you $2.59. Let's say you come to us. We're going to offer you $2.49. I mean, you're not, it's not the same type of market anymore. And I think it's going to come back at a certain point in time. I think that over the next number of years, after maybe the next recession cycle, we probably will start seeing rates going back up into the 5s and 6s. I think it's normal.
Which is more of a normal rate.
Exactly, normal market. Let's talk a little bit about, because this came up this week and it actually caught my attention. We're anticipating right now a major movement happening in the condo market this year. Right? So let me explain what, so I read this article, which I found very interesting. I can't remember the source, but it actually is echoing what I've been seeing in the market right now as well. So people basically can't find houses because there's no inventory. But where do you find inventory? You find inventory in condos. So a lot of first-time home buyers, where they would normally be going off and buying houses, this was the normal thing to do. Young couple buying their first place. They weren't buying condos in Montreal. They were buying homes. They were buying bungalows. They were buying little, semi-detached homes or, row housing, whatever. Now, all of a sudden, we're seeing a shift occurring more and more towards the condo market because there's no inventory. Mm-hmm. And the inventory that is there is just priced out of their range.
Well, a lot of big cities, buying a condo is a normal thing versus buying a home. Buying a home with a backyard is not a common thing in big cities like Toronto or New York.
We are spoiled. Yes,
yeah,
absolutely.
So this is not outside the norm, and Montreal is growing more and more. So condos are becoming more and more popular, and that's why we saw a shift also in the value of condos this year.
Yeah, and I think that it's going to continue. And one of the conversations that I've been having with my customers, they say, we're going to come in, we're going to buy a condo because we don't want to go and rent. And in 3-4 years from now, we're going to maybe look at selling it, cashing in on some of that equity and going and using that equity to buy our, first-time home or our forever home, quote unquote, depending on if they have kids or not.
Yeah, makes sense.
So it's interesting. It's a very, very interesting kind of shift that's occurring right now. When we come back, we're going to be looking at the fundamental difference between what options you have when it comes to your mortgage. But first, we're off to the CJAD Traffic Center.
You're listening to The Real Estate Show with your real estate and mortgaging team, Terry Kilakos and Merav Marciano on CJAD 800.
You're listening to The Real Estate Show, and today we're talking about rates and how to choose the right option for you. Feel free to visit us online at www.nordest.ca, or you can reach us at the office where Olympia, my office wife, is standing by to take your calls, 514-680-4674. Okay, so let's talk, Merav, here. What are the different types of options you can have when you're getting a mortgage?
So we've got obviously the fixed rate, which means over the course of the term, your rate is fixed. It's not going anywhere. Mm-hmm. Variable rate, which varies during the term. You see how I use the words?
Yeah.
And that one is basically based on your prime rate plus or minus a discount. Mm-hmm. And then you've got a home equity line of credit. That's an option as well. And that's also based on prime rate plus or minus, usually plus.
Right. So I've always said that the home equity line of credit and a variable rate are very close cousins together. Yeah. There's differences, obviously, and we'll go through each one of them. I mean, let's dive into, obviously, the fixed rates and everything. So fixed rates, I mean, they'll range. You can have a fixed term from anywhere, from 1, 2, 3, 4, 5, 6, 7, 10 years. There's some banks that'll do 15 years. I believe there's even one bank that'll do 25. Okay, so you can literally take a fixed rate for a very, up to a long period of time. The problem with getting a fixed rate mortgage, that's anything greater than, I would say, 4 or 5 years, is that the penalties that you're going to actually be paying on those mortgages tend to be a little bit higher, mm-hmm. right? Whereas when we're looking at, but the pros and cons here, what's the pro? You know what your rate is, you know what your payment is. It doesn't fluctuate, it doesn't change. It is what it is for the remainder of the term.
For somebody like me who's more of a analyst, budgety type of person, I like to know my payment. You have your payment to the penny. You know exactly what you're paying. For some people, they're comfortable with
the fluctuations.
Yes.
Yeah, absolutely. But let's look at the variable rates as well. Okay. Well, let's look at the guarantee that you have on a fixed rate. So the guarantee is the rate for the duration of the term that you have. Now let's look at a variable, because a variable also comes with a guarantee. And people don't realize this. The guarantee is the discount that you have off of the bank's prime rate, right? So currently the majority of the banks are sitting at a prime rate of 2.45%, with the exception of one bank. I was going to say two, but it's one bank who is sitting at a prime rate of 2.6%. So they have a higher prime rate. And I'll explain to you why in a second. So most banks, what they're going to do is they're going to give you, let's say, a discount of 1% off of the prime rate. So if your prime rate is 2.45 and you have a discount of 1, that takes you down to
145.
145. Simple arithmetic, right? The same bank, now this bank that has a higher prime rate, they're at 2.6. What they're going to do is they're going to give you a discount of minus 115, right? Which gives you an interest rate of
145.
145, exactly. So why would they do something like that? So why are they going to have a higher prime rate versus the other banks?
I know.
Go for it.
Marketing,
100%.
So basically, if one bank is advertising, hey, we've got an amazing variable at prime minus 1, the other bank's saying, hey, we've got an amazing variable at prime minus 115, and you're saying that bank has a better rate, but it doesn't.
It doesn't. In the end, it comes out to the exact same thing. So it's very, very important that we understand how a variable works, okay? Now, there's other ones that have really good variable. We had a really good promo that was like just recently, minus 130. I mean, there's some really interesting rates, okay? So what's guaranteed is that discount. So for the next 5 years, you know that you will always be, 1% or 120 or 130 or whatever your discount is below that prime rate.
Now, if Bank of Canada chooses to increase the overnight rate, that usually affects the prime rate.
Exactly.
And then it usually affects your rate because...
Exactly. So let's look at how the prime rate is actually calculated, right? So if we look at currently, what is the Bank of Canada's overnight rate?
It's 0.25%, 0.25.
0.25. And the banks are charging 2.45 for their prime rate. So that is a premium of, quick arithmetic there?
220.
220, exactly. So 220, they're charging 220 above the overnight rate, and they're giving the discount off of the prime. Now, interestingly enough, historically, that spread, so that premium that the banks used to charge over the overnight rate was actually 1%. Over time, what's happened, as the Bank of Canada lowered their overnight rate to 0.25, what the banks actually did is they increased their spread. So they increased from 1, they went to 1.5 to 1.75 to 2, and now we have them at 220. I personally believe, but maybe I'm dreaming in Technicolor here, that as time goes by, if the Bank of Canada starts to make really aggressive moves and they start to increase that overnight rate, we're going to see the bank start scaling back their prime rate back to maybe not as low as the 1% that they had over, but it'll scale back down, which will actually compensate for the fact that now all of a sudden the Bank of Canada has started to increase. And if you say, why would they do that? They will do it. It was at 1% at one point. It will eventually go to 1% again. I personally believe.
Okay.
That's my...
And now a home equity line of credit, which a lot of people call a Heloc.
Right.
You say it's a close cousin to the variable because it is also based on prime rate.
Exactly. So it's based on off of the prime rate, and usually a home equity line of credit will carry a rate that's 0.50 above the
prime.
The prime rate. So let's call it 295.
So 245 plus 50, so 295.
Exactly. But there are some banks that are actually 1% above it. So they'll be at 345 right now. So it's very important when you're setting up your HELOC. Not all HELOCs were actually made the same. There's some that are at 0.50, some that are at 1 above prime, and there's a couple that are at 0.65 that I've seen. And yet again, for some medical personnel and certain professionals, I've seen the banks give it at prime exactly. Right? So it does vary on the lines of credit, but it is important to remember that as rates change, so as the Bank of Canada makes adjustments to their interest rates, what you're going to end up seeing is you're going to end up seeing the HELOC start to go up, if you will, as well.
So now pros and cons of going variable or HELOC. Let's go with variable first. So variable, obviously, the cons for me, the payment could fluctuate.
Right. So what are the pros? So if you look at it, variables, typically we could convert them at any time without penalty into a fixed rate. So that's one of the good things. So for example, in this market right now where you're looking at it and you're saying, are the rates going to actually go down, next year? You might opt to go for a variable just because the difference between the variable rate, 145 versus, let's say, 259, is so big, right? So even if the Bank of Canada starts to raise rates, you're still ahead of the game going the variable route.
And now it's important to know if you do convert it to a fixed, you're converting it to the fixed rate of the day type of thing.
Exactly. But you're converting it to the term that's remaining. Okay, so I'm throwing a lot of information out right now, which you guys can call me at the office and I'll go through this with you very happily. But think of it like this. So let's say you've ridden out you took a 5-year variable, you've ridden it out for 1 year. Now all of a sudden you start to get uneasy. You want to make the conversion. You could convert it into a 4 or a 5-year term. Okay, you can't lower the term. You can't go to a 3. Well, you could if you pay a penalty, which brings me to the next thing that I like about variables. Penalties are less.
Oh, yes, good point. But I did want to ask about HELOCs because there are a lot of people who enjoy the idea of the line of credit.
Yeah.
There's pros and cons to that, and I would like to go over that after the break because I know that there's specific reasons and specific situations where you recommend a home equity line of credit versus other ones.
There's honestly, I've always said that all mortgages, whether we're taking fixed variables, HELOCs, everything, I want you to think about these tools as tools, right? These tools are there to be used, but they have to be used the right way. You're not going to use a hammer to screw in a screw. You're going to use a hammer for a nail. Use a screwdriver for a screw. So you got to use the right tools at the right time. When we come back, we're going to be looking at where we foresee rates going in the upcoming year. But first, we're off to a CTV news update.
You're listening to The Real Estate Show with your real estate and mortgaging team, Terry Kilakos and Merav Marciano on CJAD 800.
You're listening to The Real Estate Show, and today we're talking about your different mortgage options and how to choose what's right for you. If you haven't had the chance or the pleasure of doing so, please take a moment to subscribe to our YouTube channel, which is newsonthego.ca, or give us a call at the office at 514-680-4674. So before we went off to our CTV news update, we started talking a little bit about HELOCs, right? And let's go a little bit through the pros and cons of it, because I think it's important, and it's a topic that a lot of people, it's a product, if you will, that a lot of people are interested in, and rightfully so. But as I mentioned, it's a tool. I don't believe, and I've never been a believer, that a HELOC should replace a mortgage. Let me make that clear, okay? A HELOC should be used when you need to have a HELOC. And following me what I'm saying here?
But I think that the reason is the banks, the way that they sell it to you.
Yes.
We're going to pay off your mortgage and we're going to set up a line of credit instead.
Yeah.
And we've even seen clients where they say,
a ton.
I don't have a mortgage. Oh, that's wonderful. Your house is mortgage free. Yeah, I only have a line of credit.
Oh, no. I'll take it one step further. I literally have people, they come in. They say to me, I'd like to refinance. I'd like to do this. I'd like to do that. And I'm like, okay, great. So they sit down with me and I say, do you have a mortgage on your house? No, my house is free and clear. You have no mortgage on it? Nothing. Oh, okay, great. So I start everything. Then I run the credit bureau and I see $300,000 line of credit. And I say, this $300,000 line of credit, what's the deal with it? Oh, it's we got it. We switched our mortgage into that. And I'm like, who the hell told you to do that? They're like, the girl at the bank. Banks love HELOCs. Okay?
Well, number one, it
higher
compounds.
interest rates compounds differently.
Yeah.
They love HELOCs. Guys, do not use a HELOC to replace your mortgage. Okay? Very important. You have to remember something. A HELOC will report on your credit bureau like a line of credit. So because it reports like a line of credit and it's revolving debt, as you use that home equity line of credit. So let's say you have a $100,000 line of credit and you're using $20,000 of it. Great, no problem. We tacked it on. You needed to do renovations. Your mortgage wasn't due yet. You had a good rate on it. We put a home equity line of credit on your house to get your renovations done. But once those renovations are done, we roll that